Hey everyone, welcome back to Corporate Dakota, the place where we dive deep into the financial guts of companies. And today we are looking at Aethlon Medical Incorporated, a company that has been quite the story through stock splits and financing rounds. So buckle up because this filing has a lot to unpack. Let's start with where we are. The company is filing this as a definitive proxy statement, a formal invitation to their stockholders for their annual meeting on the 19th of February 2026, virtual of course, because that is just how things are done these days. They are mailing out their proxy statement and their annual report for the fiscal year ending the 31st of March 2025. Now, what is the big news? Well, they've been advancing their clinical trials for cancer and infectious diseases. And importantly, they've resolved their NASDAQ listing issues, which is a huge relief for any company. They've also made some progress in their oncology trial in Australia, where patients are being treated without any serious device-related side effects, and the Independent Data Safety Monitoring Board has given them the green light to move to the next stage of the trial. This is significant because it means they are seeing promising safety data and are ready to test a more intensive treatment protocol. What is really interesting is the detail about their lab analysis on extracellular vesicles. These EVs are like tiny messengers that tumors use to spread and resist treatment. Aethlon's hemopurifier treatment showed some promising signs of reducing these EVs in 2 out of 3 patients. That is a small sample size, but it aligns with their strategy of targeting these EVs to fight cancer. Now let's talk about compensation for the fiscal year ended the 31st of March 2025. James B. Frakes, the Chief Executive Officer and Chief Financial Officer, earned a salary of $500,000. Stephen P. LaRosa, MD, Chief Medical Officer, earned $430,000 plus $50,000 in other compensation, making his total $480,000. Guy F. Cipriani, the former Senior Vice President Chief Operating Officer, earned $199,500 with a hefty $196,188 in other compensation, mostly severance and vacation payout, totaling $395,688. Looking at outstanding equity awards for the fiscal year ended the 31st of March 2025, James B. Frakes had a significant number of options, exercisable and unexercisable. The exercise price for some of those options was quite high, over $1,000 per S-Hair, which tells us they are anticipating substantial stock appreciation. For non-employee directors during the fiscal year ended the 31st of March 2025, Edward G. Brannaman received $97,500 in cash and $50,000 in stock awards, totaling $147,500. Angela Rossetti received $63,000 in cash and $50,000 in stock awards, bringing her total to $113,000. These amounts are mostly retainers for their board and committee service. Let's touch on some of the executive departures. Charles J. Fisher Jr., MD's separation as CEO in November 2025 came with a severance package, including 12 months of base salary and accelerated vesting of 50% of his unvested equity awards. This is pretty standard for executive exits. Now for the really important stuff, the equity compensation plans under the Aethlon Medical Incorporated 2020 Equity Incentive Plan. As amended, there are 655 shares remaining to be issued upon exercise of outstanding options and warrants with a weighted average exercise price of $1,305.20. That high exercise price compared to current trading prices indicates a lot of room for potential growth if the company's stock price skyrockets. This section, called Pay versus Performance, is always a critical look at how executives are compensated in relation to the company's financial health for fiscal year 2025. Compensation actually paid to the CEO was $0, which is a bit of a head scratcher. Given the salary figures mentioned earlier for the fiscal year 2024, it was $395,249. When we look at the summary compensation table for Payo 1, which is Charles J. Fisher Jr., MD, for the fiscal year 2023, his total compensation was $460,000. However, when adjusted for compensation actually paid, it comes down to just negative $62,027. This major difference between compensation reported and compensation actually paid is due to adjustments around equity awards not paid out or whose value changed significantly. The average summary compensation for non-payo executives in 2025 was $437,844, but compensation actually paid was $430,875, a smaller gap here, indicating less equity-related fluctuations compared to the CEO. And the financials for the company are quite stark for fiscal year 2025. Net income loss was a negative $13.40 million for fiscal year 2024. It was a negative $12.21 million, and for 2023, it was a negative $12.03 million. These are significant losses and highlight the challenges the company faces in profitability. Moving on to Proposal 1, the election of directors. The company is proposing 5 nominees, including current members like Edward G. Brannaman and James B. Frakes. The board is unanimously recommending a vote for these nominees. Proposal 2 is to ratify the appointment of Haskell Fend I Amp. White LLP as their independent registered public accounting firm for the fiscal year ending the 31st of March 2026. The fees for fiscal year 2025 were $254,800, which is a substantial amount, but less than the $489,196 paid in fiscal year 24. It seems they are managing audit costs. Proposal 3 seeks approval to amend the 2020 Equity Incentive Plan to increase the number of authorized shares by 100,000. This is crucial for them to continue attracting and retaining talent through stock options and other equity awards. Proposal 4 is a big one to increase the authorized shares of common stock from 6 million to 100 million. This is a massive jump and signifies their intention to have a lot of flexibility for future financing acquisitions and stock-based compensation. Proposal 5 relates to approving the issuance of securities in connection with their private placement financing the PIPE financing involved warrants that need stockholder approval to be exercisable. This is about getting shareholder, for the shares that could be issued from these warrants. Similarly, Proposal 6 is about approving the issuance of shares from new inducement warrants, also under NASDAQ listing rule. 5,635, both proposals 5 and 6 are about fulfilling NASDAQ's requirements for significant share issuances. Proposal 7 is a standard one to approve the adjournment of the meeting if needed to get more votes for the other proposals. Let's look at who owns the company. Alumni Capital LP holds a notable percentage, around 8% Intracoastal Capital LLC, holds about 6% James B. Frakes, holds a small but significant amount of direct shares and options, which is typical for a CEO. James B. Frakes, the CEO and CFO, has been with the company since 2010 in finance roles, and as CEO since November 2023, he has a strong financial background with an MBA from USC and a BA from Stanford. Edward G. Bereneman, the chairman and director, has a long tenure with the company since 1999. He brings a wealth of experience from his venture advisory firm, and board roles he has an MBA from Stanford and a BA from Yale. The audit committee has reviewed and discussed the audited financial statements for the fiscal year ended the 31st of March 2025. With management, they have also discussed matters with Haskell CAMP. White LLP, the independent auditor. This is essentially a sign-off on the company's financial reporting integrity. Our take on Aethlon Medical Incorporated is that this is a company in a high-risk, high-reward sector. They are clearly focused on innovation in cancer and infectious disease therapies, and the clinical trial data, while early, is showing promise. Says the massive increase in authorized shares coupled with the need for stockholder approval on warrant exercises signals a strong focus on future financing and growth. However, the significant net losses are a major concern. Profitability is still a distant goal, and the high exercise prices on existing options suggest that for these to be valuable, the company's stock price needs a substantial run-up. The company is clearly in a growth phase, burning cash to fund its research and development, so the current financial picture is one of investment, not immediate return. The NASDAQ listing compliance is a positive sign of stability, and the extensive executive and director compensation packages, plus the generous equity plans, suggest a focus on attracting top talent, which is essential in the biotech space. The approval of the Equity Incentive Plan amendment and the massive increase in authorized shares are strategic moves. They are positioning themselves to raise capital and incentivize growth, but it also means potential dilution for existing shareholders. So it is a balancing act between funding innovation and rewarding current investors. Stack. In conclusion, Aethlon Medical Incorporated is a company with ambitious goals and potentially groundbreaking technology, but it is still very much in the development stage. Investors willing to bet on long-term biotech success might find this interesting, but it comes with significant risks. Alright, that is our breakdown of Aethlon Medical Incorporated's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.